So you're thinking about investing in real estate and wondering if the HELOC is the right approach to use to buy investment properties. I've used HELOCs, normal loans, all kinds of different things, everything under the sun that I could get my hands on to buy properties. So in this video, I'm going to compare using the HELOC and the traditional loan to go about actually purchasing those properties. If you're not familiar with what a HELOC is, you can check out this playlist here where I link to all kinds of videos diving deep into every aspect of the HELOC, or I wrote the book on investing into real estate with the HELOC that you can get on Amazon if you're interested there. If not, everything's for free on this channel as well. Have nothing else to sell you here. The HELOC has gotten to be a very popular tool used to buy real estate because in the recent boom of the whole real estate market, right, most people are sitting on a good chunk of equity, and now they're learning how do I go about using that and rolling that into more real estate, so hopefully that can start to build up as well. And so I want to talk about some advantages of using the HELOC to do so, and some of the things you need to be aware of before you go out and get yourself in trouble. One of the biggest advantages to using a HELOC to buy real estate is once you have that HELOC established, you can write cash offers for up to the value of your HELOC. That's essentially cash sitting in your account that you don't need to go for additional underwriting or go through an additional lender or a third party on. If you have a $50,000 HELOC, you can straight up write a $50,000 check out of that to pay for a property. And so you can avoid things like inspections or any other due diligence that scares off traditional sellers, and hopefully get a discount associated with buying that property because you're willing to forego some of those things like that. Now, I highly don't recommend you buy it without inspections unless you're an experienced investor or you have a high confidence level that you're going to go in and gut the dang thing anyway, so it really doesn't matter if something's out of code, etc. But use your own caution when doing so. But fair warning, I did let you know you shouldn't do that unless you are very experienced. But the increased flexibility of the HELOC gives you a massive benefit as opposed to somebody who's got to go out and use that traditional loan because they got to write an offer subject to this pre-approval, and then the property has to appraise for a certain amount. If it doesn't, there's this other banker who can cut the whole deal off, versus you coming through and said, hey bro, I'll give you $50,000 right here as long as the title's clear. Boom, there it is. And so it makes the transaction so much easier. You have a much higher likelihood of your offer being accepted versus using that traditional loan. Another big advantage to using the HELOC is that you have that money liquid available there. Most people don't just have hundreds of thousands of dollars just sitting liquid in an account because it's not really prudent to do so. But a lot of people do have home equity. So it's using the tools available to you to go out and take advantage of real estate opportunities, versus when you go with a traditional loan, you actually do have to have those liquid funds available to put down as a down payment to be able to move forward with that property, right? So if you don't have the funds in a liquid form, but you do have a good cushion of equity, the HELOC can be a great tool to go out and tie up property and take it down that way. Now, the biggest downside with buying an investment property with a HELOC is the variable rate and the typically higher interest rate that you're going to get relative to a fixed, 30-year loan. That interest rate is going to be slightly higher, and it's going to be variable. So you might think you know what you're walking into this month, and then the Fed can adjust interest rates and your payment goes up the next month. So there is that uncertainty risk, although you should underwrite a deal for a little fluctuation and be prepared to make adjustments there. But you're typically going to be paying a higher interest rate on that property when you buy it with a HELOC. However, with a HELOC payment, you're only paying that interest portion. You're not paying any principal down. So you're just effectively treading water, which is okay if you have a short-term mindset and you're just, maybe you're flipping a property, right? That's fine. Most flipping loans are just interest only anyway, but I want you to be prepared for that going into it, knowing that you don't make payments on something for 5 years thinking you're paying it down, and yet you've just kept up with the interest. And now you're in the same spot and you owe the same amount of money that you took that original loan out for. So with the HELOC, it's going to be higher, it's going to be variable, and it is going to be interest only. And if you want to deep dive into just HELOC interest payments, check this video out up here where I did a whole video just on how those operate and how they work in general. The biggest disadvantages associated with using a traditional bank, obviously it comes with a little bit of that higher level of scrutiny with the underwriters and a bank approval on getting that done. But that's pretty much table stakes. The biggest disadvantage for most people is the capital that you have to leave in a deal, right? If you have to put 25% down, let's just use a $100,000 house, you're putting $25,000 into a deal. That kind of limits you of how many of these you can go out and buy, right? Well, if you have $50,000, that limits you to 2. You have to leave that money in a deal, or if you buy a house, you have to then do another transaction, whether either cash out, refinance, etc., to get that money back out, or else it's really just stuck into that property. So we talked a little bit about the pros and cons to both the traditional loans and the HELOC. But the biggest consideration factor, in my opinion, on whether or not you should use the HELOC is if you have a plan to get that money back out. Right? So a HELOC is not a great tool for a long-term investment into rental property or real estate investing in general. I always recommend a 6 to 12 month plan to be able to get that money back out of that investment so that you can pay it back off and have that money available to use again on the next opportunity. If you're just sitting there paying interest only on a HELOC for 5 years, you're kind of defeating the whole purpose of investing in real estate in general. The only avenue of which you're benefiting is the monthly cash flow, assuming there is any with the high interest rate, and the appreciation. You don't get that debt pay down, and it just leaves you in an overall more risky position when you're just paying interest only over the long term. So HELOCs typically work great for flips, wholesales, things that you have to tie up, but you do have a plan to increase the value significantly to either, sell via flip, or if you want to burr the deal, or if you want to do a cash out refinance in 6 to 12 months because you're going to do something to that property. Maybe you're going to add a third bedroom. Maybe you're going to fix the bathroom or the plumbing or whatever. You got to have some kind of plan to be able to increase the value so that you can then cash out refinance, get that money back, pay your HELOC off, and then have that HELOC available to use again and again. If you want to know the differences between a cash out refinance, a traditional refinance, check out this video here. That's helped a lot of folks kind of think through that model. Like any investment, you typically want to have more than one exit strategy or more than one plan to be able to get yourself out of a bad position if the deal doesn't go the way you thought it was or the market turns in a different direction. If you want to deep dive into all the different ways that you can pay off a HELOC once you have put that into an investment property, check out this video here and I'll walk you through every way I know to go about getting that payback off. But moral of the story is you really need to think through both scenarios, weigh the pros and cons with your investment approach and with your ideal outcome. Everybody has different outcomes when they buy a rental property, whether you just buy it for rental properties, tax write-offs, depreciation, cash flow, etc. As long as you're clear on what your criteria is and you ask yourself if this particular tool helps you get there, that's the thing I don't think enough people do. Too many people go out and they hear about a HELOC, so they use it and buy a property, and then they ask themselves, then how do I get out of this mess? The HELOC is incredibly powerful, but it also assumes a lot of risk. So with risk, you really have to think through and be responsible. Ask questions before you get yourself in an investment. I always recommend that you have someone you can go to for advice and you can ask questions, get a second opinion before you go out and leverage your home, especially if this HELOC is tied to your primary residence. This is where you and your family sleep at night, so don't risk that on a speculative investment. But guys, if you got any value out of this video, I'd appreciate a like, subscribe, or share down below. I answer all my own comments. I would love to hear your comments. If you want me to be that trusted advisor, give you an opinion on a particular situation, I'd be happy to do so. Just share my thoughts. I'm a small channel. I still personally respond to all the comments, so I'd appreciate any down below. But with that, guys, we'll catch you next time.